it's a little bit of some thoughts about the real estate markets, what's happening, and also I think a little bit what's influencing the world around. So I will start with interest rates, which is possibly not very surprising, and we'll end up with a view on interest rates. So I think that's more or less the framework. And I think over the last 12, 18 months, everybody has been talking about what's happening to interest rates. With the last 2 months, people are starting less to talk about interest rates because we are not so much worried about what will happen when interest rates rise, because now it becomes clearer and clearer that over the next 12, 18 months we possibly will not see any kind of large interest rates movements going forward. And that will definitely impact real estate, because at the end, a lot of the fear over the past, let's say 12, 18 months was what's happening with real estate when interest rates rise. If interest rates are not rising, then a lot of what we were thinking about the last 12 months is possibly not really what will impact the market going forward, but it will even increase the pressure on a lot of the areas we are currently seeing. So if interest rates is not the big story, at least for the next, let's say 12 months, one thing that is the story, no matter to whom you have talked over the last 2 or 3 years, is it's the thing about urbanization, what's going on. And what we've plotted here is not urbanization itself, it's just a view on some statistical regions the EU maps out, and it's looking at working age population. But because ultimately, if we think about real estate, it's not about the overall demographics. A lot of real estate, especially the commercial side, but also residential and retail, it's related to where do the working age population live and which regions are growing. And if you look at from that perspective on Europe, there's actually only a third, maybe max, of all regions in Europe that is growing. So there is a concentration of activity. So all of us who are operating in the real estate industry, and all of you who are looking at German real estate, they are looking more or less at the same regions, at the growing regions, and that increases the competition in an environment where we possibly won't have rising interest rates, and that has a huge impact on prices and also on the possibilities that are offered in the real estate market. If you then put, let's say, Europe in a little more, let's say, global context and look at, as a global investor, how does Europe fit in there? Roughly 50% of all transactions in real estate taking place in Europe. So Europe from that side is the biggest global real estate market. And if you look at Europe in a little more detail, there are 3 big markets, France, the UK and Germany, with the UK and Germany neck on neck as the 2 biggest markets, concentrating about 50% of all transactions. So any player who really targets Europe in his global allocation for real estate will have a view on France, UK and Germany. And we had the Brexit word already, so I don't want to talk about the UK in detail, but that has an impact, at least tactically, on how a lot of people allocate their capital on a short-term horizon basis. Coming now to the German market in a little more detail, and what I tried to map out here is a little bit of distinguish between commercial and residential, because on the one side, we are a player that is quite active in the resi market. And on the other hand, I think resi and commercial, if you will see it in the following slides, is a little different when you look at the players in Germany. On the left-hand side, you see the share of international players when it comes to the commercial market is roughly 50%. A lot driven also by these flagship landmark towers that in Frankfurt are sold. While on the residential market, only about a third of all transactions are done by international players. So resi is still a much more domestic dominated market than the commercial sector. I would also argue it has a little bit to do with the factor of transparency in the commercial sector when it comes to data on yields, rents and all these kind of things is a little better than it is in the resi sector. So you possibly require much more local knowledge to understand what's going on in resi. And when you now look at where does this cross-border money come from and where does it go to, you see there is a wide variation of countries that are investing cross-border in Germany. And the largest share is going really to offices, dominated definitely by these large towers and large asset sizes, and only a smaller proportion quite equally to resi, retail and logistics. But you see also that the pattern of investors is quite different no matter which sector you're looking at. So there is a huge variety, and there are preferences of the investors when it comes to sectors. When you now look at the 2 sectors in a little more detail, and when you talk about Germany and the federal structure of Germany, it's not like France and the UK with one dominating city. Germany is always told we have the top 7 cities, and The top 7 are quite equally dominating the overall transaction market in Germany, as does France or London in the UK and Paris in France. So I think the top 7 are within itself a cosmos of a investment universe that enables you quite good diversification. And when you look at the transactions in the commercial side, roughly 2/3 of all transactions in the commercial sector take place in these top 7 cities. But you see the share of the different cities is quite varying. Stuttgart with one of the most local markets, possibly with the smallest share, and Frankfurt, Munich, Berlin are more or less on equal size when it comes to where do the investments in the commercial sector take place. When you look at this on the residential side, the picture changes dramatically. Because not only it's only 50% that it's in the top 7, but these 50% are more or less half of all transactions are then in Berlin, which again shows also how important history is for understanding where capital flows are going. Because Berlin is a market where you have seen over the last 15, 20 years a lot of activity, international players, domestic players buying single assets, building up portfolios, trading on these portfolios, and then repackaging part of it. So the Berlin market is one of the most liquid ones. I would say it's even the most liquid residential market when you look at Europe, and that is mirrored in that picture. But what it also tells you is there are 50% of transactions outside these top 7 markets. So there is a lot that is interesting for investors that is not the top 7 markets in Germany. So I think that is the other story to look at from that perspective, because that gives a lot of opportunity if you have the local knowledge and understand what's going on. And if you try to map a little bit what has been going on in office, retail, logistics and residential, you see on the one side the dominance of the top 7, Munich, Stuttgart, Frankfurt, Cologne, Düsseldorf, Berlin and Hamburg. But you also see there is a lot going on outside these markets, but which requires a little bit of an understanding how the federal structure is mirrored in the importance of these cities. Are these university towns? Are these regional governmental headquarters? So that's what has to be understood. But that already shows you how the structure of Germany is mirrored in the transaction activity. And what I want to end up with, when I started at the beginning, I told you about interest rates and their impact on real estate, which was the big talk about in the last year. We started to look at this in a longer term perspective, and when you look at interest rates, the 10-year government bond, which is a gray shaded area, and prime yields as far as they're available for the different sectors, back to the 1990s, you see that actually, even if we talked about this a lot last year, we shouldn't been that afraid about what will happen when interest rates rise, because we had phases where government bond yields and interest and property yields were on level, or even government bond yields were higher than property yields. It might have been a less mature real estate market at that time in the 1990s, but if history tells us a story, it definitely tells us the story that if history repeats itself, can be a phase again when interest rates go up, that maybe property yields and government bond yields come to par, which will then mean that even interest rates rising will have a very limited impact on property yields, much less than a lot of people possibly expect. And that might be the challenge then going forward, because then these opportunities in a rising rate environment might not materialize. And at the end, that means for investors, understand your business, work with the asset and have ideas what you can extract value out of an asset, which might be a much more important story going forward than trying to identify what the impact of interest rates on yields is. So that may be as a starting point for the panel. And I hope I gave you some ideas what you can ask the participants, and otherwise I think you have your own ideas.